Hi, everyone, and welcome back to Markets in 2 Minutes. This is Connor Darrell from the WealthSpire investment team. And today we are going to discuss one of the more widely covered stories in financial news over the past several weeks, which is the decision by Fitch to downgrade the US credit rating from AAA to AA+. And for obvious reasons, this decision caught a lot of attention. But our thought process at this point in time is that just as it was back in 2011, when S&P made the same decision to downgrade US debt, this is largely a non-event from a market perspective. And this chart we're showing here reflects the 10-year Treasury yield back in 2011 when that initial downgrade from S&P occurred. And you can see that yields actually declined following the downgrade as there was a bit of a flight to quality across markets as some nervousness set in, which is actually counterintuitive. You'd expect to see rates creep higher if there was a credit event. And this time around, we didn't necessarily get the same type of drop in yields, but we saw nothing in the price action to suggest to us that there was any change in the market's perception of the United States' creditworthiness as a result of this note. Yields have crept higher over the last month or so, but that's been more a reflection of Fed policy and their desire to keep rates elevated as they fight inflationary pressures, rather than anything that would be consistent with any kind of credit event. Now, that's not to sugarcoat the fact that we do face some real structural issues, or as Fitch stated in their note, a deterioration of governance. But there are a couple of things to keep in mind with respect to how the government is managing its liabilities. We have two charts here on this next slide. The one on the left shows the interest costs that the government faces in paying its debt down relative to the size of the economy as measured by GDP. And you can see the material impacts that lower interest rates have had, which is to drastically reduce the annual interest payments relative to where they were back in, say, the 1980s. You can also see on the right-hand side a chart which shows some projections from the CBO with respect to where they see interest expense as a percentage of federal outlays moving forward. And this chart goes out to 2028. And you can see that they anticipate things will plateau in the 12% range, which is still materially lower than where they were, at certain points in history over the past 50 years. So this is, of course, a development that we'll continue to watch closely. But we do not believe investors need to be concerned with the debt downgrade from a portfolio perspective. It certainly reflects potentially broader issues with the functioning of our political system, but there's nothing here that suggests to us that investors should be looking to steer money away from the US bond market. And so I'll leave you with that quick thought, and we will be back with another market update in short order. Have a great day.